You know, growth takes place in the valley. Typically, growth does not take place when you're on top of the mountain. And I started teaching people about private money and how they can earn high rates of return safely and securely, and how they can be protected without attaching a deal to it. Because here's a writer downer: I make the rules. You see, I said at the beginning of the show, institutional money that you borrow, they make the rules. In this world of private money, we're not asking for a mortgage, we're offering. Take 100% responsibility for everything that happens in your life. And in that first chapter, there's an amazing formula that will set you free on learning how to make choices.
Welcome back to the Hustle and Grind podcast, the show where we dig into why real entrepreneurs trade comfort for conviction. This isn't about vanity metrics or overnight success. It's about the stories behind building a reputation that actually matters. I'm your host, Andrew, keynote architect, platform builder, and fellow founder in the trenches. Today, I'm sitting down with Jay Conner, the real estate investor and private money expert who turned rejection from a banker into a seven-figure business. Jay started in real estate back in 2003 doing deals the traditional way: big down payments, origination fees, personal guarantees. But when the 2008 crash hit and his banker cut him off, he had to rebuild from scratch. That's when he discovered the power of private money and developed a system that helped him raise over $2 million in just a few months. Now he runs a highly profitable business in under 10 hours a week. Let's get into it. So, Jay, I'm honored to have you on the podcast today because you are in a space that I am very passionate about, and that's private money. So I'm really looking forward to having a great conversation with you today.
Andrew, thank you so much for inviting me along to come about and talk about the topic that I'm so excited about, private money. Why in the world am I so excited about that? Because private money's had more of an impact on my real estate investing career than anything else that we have ever employed into our business. It was the biggest game changer. It still is today. I've never missed out on a real estate deal for not having the funding ever since February of 2009.
Absolutely. And I think it's something that a lot of people don't think about. Whenever I ask somebody, how much is your 401k making? I have not gotten, even people who are pretty sophisticated investors, I haven't gotten a single answer that was direct. I think it's making this, and it was never a very good number. I think a lot of people don't realize there's other options out there and they're not that hard. So that's why I'm really looking forward to kind of getting into the conversation about what this looks like. But first thing I want to do, like many others, you ended up with the crash of 2008 was a major pivotal moment in your life. I think
Major.
probably the polite way to say that. And a lot of people had this issue as well. So, do me a favor, tell me the story about 2008, what happened to you and how you pivoted.
Sure. Well, you know, growth takes place in the valley. Typically, growth does not take place when you're on top of the mountain. Well, my wife, Carol Joy, and we met my very first Sunday in town at church in Wichita Falls, Texas. We've been living here in eastern North Carolina ever since 1988. We started investing in single-family houses in 2003, full-time, here in a very, very small market. Our total target market's only 40,000 people, but we'll do on average 2 to 3 deals a month. Average profits right now are $86,000 per deal. I do not share that to brag or come from a space of ego. I share that to make a point, and that is there's an argument to be made that you can be a big fish in a small pond and sort of dominate your market. That's why we do, and that's why our average profits are $86,000 each. We started investing in 2003, Andrew, and from 2003 until January 2009, our first 6 years of investing, what we did is I went to the local bank, and here's how I got my deals funded. I go to the local bank, I get on my hands and knees, I put my hands underneath my chin, and I say, please fund my deal. And my banker would make me pull up my skirt so they could look at all my personal assets, pull my credit report, look at my financial statements. And they made all the rules. In fact, that's what most people think you have to do when you're borrowing money for real estate is he who has the cash makes the rules. So that's what I was doing. Well, that worked out okay, until January 2009. Andrew, I was sitting right here at this desk maybe hard to believe for you and some of your audience to know, we actually still have landlines here in my office with cords attached to it. But anyway,
Love it.
I was sitting here at my office. I picked up my phone here and I called up my banker. His name was Steve. He was working for BB&T at the time. Nowadays it's called Truist. And Steve and I had a great relationship for 6 years. Steve was the main funding source using institutional money for my single family houses the first 6 years. I called up Steve in January 2009. I had 2 houses under contract to buy. They in total represented over $100,000 in profit between those 2 deals. So I called him up. I told him about the 2 deals, and Steve and I had this kind of conversation many times for 6 years. I didn't know anything was different. And so I learned immediately over the telephone. Steve informed me that my line of credit for my real estate investing had been shut down with no notice. And I said, Steve, what in the world are you telling me my line of credit is closed with no notice? We've got a great, business relationship here. We've done a ton of deals. Why are you closing my line of credit? Steve said, Jay, don't you know there's a global financial crisis going on right now? I said, no, I don't know anything about that, Steve, but I know one thing. You just gave me a global financial crisis. I don't have a way to fund my deals, particularly these 2 deals. He said, sorry, Jay, we are just not loaning any money out to real estate investors. So I hung up the phone. Andrew, I sat here at my desk for a moment, and I asked myself a very important question. I want to share this question with you and your audience. It's very powerful because, the power is asking the right questions. And I asked myself, Jay, who do you know that can help fix your problem? And by the way, these people running around saying every problem's an opportunity. I want to throw up and be the Kool-Aid guy that runs into a brick wall. I didn't have a problem. I didn't have an opportunity. I had a problem. Yeah. Let's face it. I had a problem. So I asked myself, who can help me fix my problem? Immediately, it was immediately when I asked myself that question, I immediately thought of Jeff Blankenship. He was living in Greensboro, North Carolina at the time. Carol Joy and I know him for many, many years from singing at gospel Christian events. And he was investing in single family houses in Greensboro, North Carolina at the time. I called him up and I told him what had just happened with my banker. And Jeff said, well, welcome to the club. I said, what club are you talking about? He said, the club of having the bank shut down your credit. He said, my bank just shut me down last week. Now, this was January 2009. My first thought was, well, I'm talking to the wrong dude here. I said, well, Jeff, how you going to fund your deals? He said, well, have you ever heard of private money? I said, no. What's private money? He says, well, let me ask you another question. He said, have you ever heard of self-directed IRAs? I said, no. What's that? He said, well, a self-directed IRA, as I understand it, is a third-party custodian company approved by the IRS that allows individuals to move current retirement funds over to their company. Then they can lend that money out either tax-deferred or tax-free to us real estate investors. I said, Jeff, I don't have a clue what in the world you're talking about. I said, how am I going to learn about private money? He said, well, there's this guy down in Jacksonville, Florida by the name of Ron LeGrand that can teach us all about private money. I said, well, what is it? He said, I don't know, but Ron says we can get a lot of it for our real estate deals. So Jeff and I went to my very first real estate investing conference and seminar, which was Ron LeGrand's seminar all the way back in 2009. I learned about private money. I came back home, and what did I do? I raised $2,150,000 in less than 90 days. And how did I go about doing it? I decided that I was going to go about raising money without ever asking for money. And you know what's interesting, Andrew? To this day, this is 2025. To this day, I've never asked anybody for money, and I've never pitched a deal. And people say, Jay, how in the world do you get all that money for your real estate deals and you never pitched a deal? Well, there's 2 parts to it, and then I'm going to turn it back to you, Andrew. First of all, I tell people, It's very hard to raise money until you own the real estate between your ears and get your mindset right. So the first thing I did is I put my program together that I was going to offer without any deals attached to it. What rate am I going to pay? It's 8%. I've been paying 8% since 2009. It hadn't changed since. No origination fees. Maximum loan to value is 75% of the after repaired value, et cetera, et cetera, et cetera. So I put my program together, and then what did I do? I put on my teacher hat, which says private money teacher, and I went about in my own connections, people on my cell phone, people I go to church with, people in the Rotary Club, people I've already got an association with that they know me, like me, and trust me. And I started teaching people about private money and how they can earn high rates of return safely and securely, and how they can be protected without attaching a deal to it. Because here's a writer downer: desperation has got a smell to it. Meaning, if I'm talking about private lending opportunity and I got a deal attached to it, I'm already saying in so many words, I need you to fund my deal. I'm already sounding desperate. When's the worst time in the world to be trying to raise private money? When you need it for a deal, right? And so I wanted to establish these relationships and teach people. I did a private lender luncheon, and I got a pledge of $969,000 from one private lender luncheon with no deals attached to it. So then how do I get my deals funded without ever asking? And then I'll turn it back to you, Andrew. I'm going to share with you right now, with you and your audience, what I call the great news phone call. Here's the script. The great news phone call. Andrew, let's say hypothetically you're one of my new private lenders. Let's say you got $150,000 in a previous 401k at a previous employer. You're not happy with what it's doing. I've taught you the program. I've taught you the interest rate, how you can get your money back in case of an emergency, how you're protected, being named as the mortgagee on the insurance policy, and all that kind of good stuff. And you love it. You love the program. You say, Jay, I'm interested in that. I'd like to do that. And I say, okay, well, I don't have a deal for you today, but I'm going to put your money to work for you just as soon as possible. So a week or two goes by, and I call you up, Andrew. Here's the exact script, the exact words that I say to Andrew to get my deals funded 100% of the time. I call up Andrew, my new private lender. We have a little chit chat. And then I say, Andrew, I've got great news for you. I can now put your money to work. I've got a house under contract in Newport with an after repaired value of $200,000. Now the funding required for the deal is $150,000, which matches up to what you have available in your retirement account. Closing is going to be next Tuesday, so I'll need for you to wire your funds to my real estate attorney. I'm going to have my attorney email you the wiring instructions. That's the end of the conversation. Now, let's unpack why Andrew wants to do that deal, and he is ecstatic to get the great news phone call. First of all, Andrew's not earning any money on his money in the retirement account until I put his money to work. He moved his money over at my recommendation. I introduced him to the self-directed IRA company. He's done what I recommended. Now he's wanting to put his money to work. He's not making any money until I put his money to work. I'm ethically and morally responsible and obligated to put his money to work. And then secondly, I'm not going to bring Andrew a deal to fund that does not meet the criteria of the program that I already taught him before he even moved his money over. So teach, lead with a servant's heart. You know, I got 47 private lenders. Not one of them ever heard of private money or private lending until I put on my teacher hat. None of them ever heard of self-directed IRAs and how that works until I put on my teacher hat. And we're not in a rush. We're not desperate. We follow that. I call them up with the good news phone call, and everybody is happy.
So I should let you in a little bit of a secret. My license plate is BYO Bank, and that's specifically for this reason. And as a lot of people don't realize that this is an option. You know, every person, we were talking before the podcast today, that every person I have come in contact with, and I've asked them, how much is your 401k making? And some of these are people that really watch their numbers, have no idea how much they're making. And unless you're making over 3%, that's the average inflation over the past 100 years. Unless you're making more than that, you're losing money. And I think a lot of people don't think like this. They think, I'm in the stock market, it's a long play, I'm making maybe something. My financial advisor knows what they're doing. And they don't realize this might be an option. So that's why I'm really excited to have you show people that there is another way to do this and to earn something better than the 2% they're probably making on things at this point. So yeah. So what do you say to people when they first, like, what is that moment like where they've taken the red pill? They know there's another option now. What's that thing that gets them over the hurdle going, this isn't really risky. Probably the stock market's more risky. What do you need to get them over that? Like, what's that one thing that really helps them to understand it for anyone out there who's intrigued, but still not quite, there?
There's three big reasons why private lenders love doing business with us, get interested in doing business with us, and stay with us. I mean, when we cash out on a property and we send them their payoff back, they don't even want it. They'll say, "Can't you just keep it?" Well, I can't keep it because I'm collateralizing their notes. And then so we go do another deal. Three big reasons why they want to do business with us. Number one, they're going to make a whole lot more money than they can through traditional sources, such as a certificate of deposit at the local bank. I've been paying 8% since 2009. People say, "Jay, how in the world are you paying the same thing today that you were in 2009? And markets have gone up, they've gone down, they've gone up, they've gone down. How can that be?" Well, here's the first reason why I'm still paying them 8%. I make the rules. You see, I said at the beginning of the show, institutional money that you borrow, they make the rules. In this world of private money, we're not asking for a mortgage, we're offering. We're offering an opportunity. So since I'm offering it, I get to make the rules. We get to set the interest rate, the term, the length of the note, the frequency of payments, all that. And the second reason they love the interest rate is because 8% today is still a whole lot higher than they could get. A little over a year ago, you could get 5% in a local CD for 7 months at First Citizens Bank right here on Bridges Street in Morehead City, North Carolina. That same CD today is 3.5%, and it's coming down fast, right? But even at 5%, 8% is a whole lot more than 5%, and their notes are collateralized. So number one reason, they make a lot more money than through traditional sources. The second reason that they absolutely love it is because their investment with us is secure and it is safe. So how's it secure? We're not borrowing unsecured funds. We're collateralizing the note. We're naming them on the insurance policy as a mortgagee in case there's ever a claim. The checks are made payable to them as well as me, with them being the lender. We name them on the title policy as additional insured. And along with that, it is safe because it is a conservative loan to value. We're not borrowing more than 75% of the after repaired value. Bear in mind, I did not say 75% of the purchase price. Yeah. Big difference. Since we're buying these properties at a significantly discounted amounts due to them needing renovation, we always bring home a big check when we purchase every property. We never take any of our own money to the closing table. If you're listening to this or watching this and you're a real estate investor, who wants to get paid to buy houses, right? We always bring home a big check when we buy. So they're going to make a lot of money. It's safe, it's secure. And thirdly, their investment amount, the value of it is not volatile. So I'm contrasting this opportunity to being a private lender with investing in the stock market. When you invest in the stock market, my lens is the market volatile. Well, yeah, take a look at the past week and tell me if the market is volatile or not, right? I mean, what you could have owned last week is worth, 10% less today than it was. It can be worth more. And there's fees and commissions. In this world, there are no fees and commissions. The investor, the principal lender, the lender knows exactly what their return is going to be. I love what you said a moment ago, Andrew, when you said you asked people, well, what rate are you getting consistently, in your retirement account? They don't know.
No.
Well, a private lender knows exactly what their rate of return is going to be. It's like putting money in the local bank. Instead of knowing percent, they know that with no fees, no commissions, and nothing else coming out of that.
Yeah. And I think that's the one thing that people don't realize is a 401k is not for your benefit, it's for your employer's benefit. And there's fees behind it as well. And you're probably not making 4% in that. You're probably making 2 to 3. And so it's barely keeping up with inflation. So just from the digging that I've done on it. So I wanted to bring that up because that's what people do. They think I put a certain amount in my 401k. I have a match, so that's free money. It's not always advantageous, and I think people need to have that additional information that there's another place out there. So I'd like to pivot for a second because you've mentioned you go into creative financing, and I think that's a world that a lot of people know less about than private lending. I think some private lenders don't understand creative finance. Tell us a little bit about what that is, because just interesting. Yep.
Well, there's all kinds of creative financing. One of which is sort of an advanced technique if no one's ever done it. But one way to have creative financing is to combine more than one strategy together on the same deal or the same transaction.
Yeah.
So, in the world of single family houses, one creative financing strategy is to buy a property what's called subject to the existing note. Mm-hmm. So, a seller will sell you, a motivated seller that's looking for debt relief will sell you their house and agree to keep the mortgage in their name, and you agree to make their payments, and if they have any back payments, bring those payments current. And so over 90% of people within the last 3 years refinance their properties. And you're talking 3 years ago, interest rates of 3%, 2.75%, 3.25%. So when you buy a property subject to the existing note and the seller is keeping that mortgage in their name and you're making the payments, you essentially just inherited a 3% interest rate, right? Now, along with that, you can combine private money and borrow private money if there's equity in the property, because you got to protect your private lender. So if there's equity in the property, you can borrow private money and collateralize that note in what we call second position or a junior lien position. And the key is you'll want to add what's owed on the first mortgage to the amount of private money you're borrowing in second position. Add those two together, divide by the after repaired value of the property if you're going to renovate it, and you still don't want that total loan to value to exceed 75%. So creative financing, well, some people would call private money in and of itself creative financing. It's definitely not institutional money. Another creative financing scenario could be if you're buying a single family house and let's say the seller owns it free and clear. So now the seller can be the bank, take a note back, and you make monthly payments to the seller if they're interested in longer term income and not having to pay tax on that sale amount. Well, if there's equity in the property, and there should be, then you can again borrow private money and put that in second position, because first position is the note that you gave back to the seller. And you could use private money in second position and combine those two strategies together. So there's all kinds of creative ways to buy a property without using institutional money.
And I wanted to mention that too, because this is an additional kind of feather in the cap of this is not as risky as people think it is there's more than one way out of a real estate transaction. I mean, it's not like you buy the house, you do this, and it's not exactly the same formula every time. There's a lot more creative ways to do it. And so that way, then if something goes wrong, you pivot.
And that's what I love about real estate, particularly single family houses. There's always multiple exit strategies.
Yeah.
I mean, you can get the property under contract. You could wholesale it if you want to and not stay in the deal, get a wholesale assignment fee, and, wham, bam, you're done. I've never wholesaled a deal in my life. I don't have anybody to wholesale it to. And plus, I like staying in the property and staying in the deal and making the big profits. But you can wholesale it if you want to stay in it. If you don't want to do anything to it, you can turn around and sell it on lease purchase or rent to own. And the longer you own a property, if you do it right, the more money you should make. You can rehab it, put it in the multiple listing service. You can do what I did years ago when the market was really slow. I rehab it, put it in the multiple listing service, and offer it for lease purchase, rent to own. And if I sold it on lease purchase, I would force them into credit repair and take about 18 months to get their credit cleaned up to where they could actually get a mortgage and cash me out. So again, as you say, Andrew, multiple exit strategies always.
Exactly. And it's one of the nice parts about real estate is there's a lot of advantages to it. And I don't think enough people really take advantage of it. And they think it's going to be tenants, termites, and toilets. And no, there's another side to it, being the bank is the ultimate. So I had a friend of mine cash out. He had 90 doors, crashed out everything, and is now the bank. And that was his ultimate play, is being that bank. But the other thing I wanted to touch on really quickly is a last question, because it's something that I've seen done regularly, but a lot of people don't understand. They know like first and second, third position on a title, meaning, if there were a foreclosure, the first person gets paid, then the second person gets paid. It kind of rolls downhill. But there's another way to do this. So let's say there's 3 different lenders on the property. You can put them all in first position. And it's something that not a lot of people, not all states, only some states can do this. But is that a strategy that you use as well?
Yeah, I've never done that, Andrew, and I'll tell you why I haven't.
Sure.
But then I'd like to come back to you for you to tell the audience how you can do that, in case someone's in a state that can take advantage of that. So when I have multiple lenders, I disclose to the lenders on the promissory note what position that note is in. So I use larger amounts for the purchase of the property. So whoever's got the most money goes in first position if I'm using more than one lender on the property. And then the smaller amounts I can use for renovation. So I would disclose on the promissory note if they're in second position or third position. I've never had a problem with it doing it that way, because all of my private lenders have been taught by me. I taught them this world. And so there's a super high degree of trust that's cranked into these transactions. But if you're talking with a private lender that knows about this world, there's some private lenders that refuse to be in a junior lien position. They only want to be in a first lien position. So Andrew, please talk through the logistics of how you do that.
So some of the reasons or the ways I've seen this happen is, let's say I have $150,000 that I need to borrow. I'm below 70% LTV, which is kind of where I like to sit. So, and I'm within my criteria. But let's say that I have one lender. So 150 is what I need. Let's say I have one lender with 125, and that's all they have left in their IRA because they have the rest of their money working. And I've got another one with 25. I can put both person in first position in some states. This isn't in all states, but I know I'm in New York State. We can do that here. And so what it is on the loan notes and on the mortgage, it actually lists both people out with a percentage ownership in that first position lien. And so it's a different way. So if somebody has like 25,000 left over and they just want to throw it into a deal, but they don't want to take second position, there's another option for it. So it's a little bit of a different way to do it.
There. So it's one promissory note and one. In New York, are you a mortgage state or deed of trust?
We're a mortgage state.
So you're a mortgage state. So the mortgage, it discloses that John Jones owns 75% of this mortgage, and Sally Smith owns 25% of the mortgage.
Correct.
And they're both in first position.
Yeah, exactly.
Simple enough.
Exactly. And it's fully disclosed. It's in the mortgage itself. It's in, everything is kind of across the board on it, but it's another thing you can do. It's called pooled investments. Sometimes you can do it. Some states you can't do it. I don't know if you can do it in North Carolina. I haven't really had a deal down there that I've seen it happen. So I don't really have too much data on it, but it is an interesting concept that a lot of people don't know is an option, especially if you got a little left over in your 401k because you're using all your money, or you're in your IRA. You're using all your money. You have a little bit left over. You want to make sure we use every penny. So I want to go back to CDs. I call CDs can't decides, because that's where you put when you can't decide what to do with your money.
Oh, that's funny. That is funny. I've had over 700 episodes on my own podcast. I've been a guest on over 800 podcasts. I've never heard anybody call a CD can't decide. That is funny.
That's an original. If you want to use it, you're more than welcome to.
That's why I hadn't heard it. It's original.
Well, I was thinking about it one day going, when is the only time you're going to use a CD? And it's like, if you can't decide what to do with it, you're going to put it into that and store it away. It's stuck, So yeah, exactly. Not a fan of CDs. They just don't get a return. My bank is Ally Bank, and they have probably the highest CD rates in anything out there, and they're about like 3.5%, 4% right now. So it's just not worth it. But well, we're getting towards the end of things here, and I do have one question that I ask everyone, and that is, what is one book or podcast that has had a significant impact on your life that you want to share with the audience?
Ooh, that is a hard question, Andrew, because what has had the most beneficial or what has benefited me the most in my growth over these years, professionally
Mhm.
and personally, has been the books I read and the people I meet and the relationships that we nurture. But I'll choose one that's definitely in the top five, and that is the author is Jack Canfield, and he was the co-author for Chicken Soup for the Soul series decades ago with Mark Victor Hansen.
Mhm.
Anyway, he came out with a book about 10 years ago that is timeless. In fact, it was just republished again, 10-year anniversary. The name of the book is called The Success Principles.
Mhm.
The Success Principles. And Jack Canfield has identified 65 success principles that are foundational and are a common thread among the most successful people on the planet. I will tell you the very first success principle, it's foundational for the other 65, is his principle number one. And that principle number one is, quote unquote, take 100% responsibility for everything that happens in your life. And in that first chapter, there's an amazing formula that will set you free on learning how to make choices. The formula is E plus R equals O. I'm not going to tell you what it means. You need to go get the book. E plus R equals O will help you determine and take full responsibility for everything in your life.
Well, Jay, thank you so much for being on the show today. I really appreciate you being here. Thank you so much.
Thank you, Andrew. And I would love, if you'll let me, I'd
Yeah,
love to give a gift. I'd love to give a gift to you and your audience. And that is, I'm so excited about my new book, which is titled Where to Get the Money Now. Subtitle is How and Where to Get Money for Your Real Estate Deals Without Relying on Institutional or Hard Money Lenders. This is not an ebook. This is a book. It's $20 on Amazon, but don't spend $20 on Amazon. I like to give your audience the book for free. Just cover shipping. I'll autograph it. You can, and I'll send it out 3-day express. You can pick up my book, Where to Get the Money Now for Your Real Estate Deals, at www.jayconner, JAYConner.com/book. I'm an ER, not an OR. JAYConner.com/book, and I'll rush it right out to you. I'm going to include with the book 2 tickets valued at $3,000 to my upcoming private money conference as well.
Excellent. Thank you so much, Jay. I appreciate it. For those that want to take advantage of this amazing offer, go down and take a look at the show notes. The links will be there so you can sign up. Awesome. Well, again, Jay, thank you so much for taking the time out of your day and spreading some wisdom with us. I really appreciate it.
Thank you for having me, Andrew. God bless you.
Thanks for tuning into the Hustle and Grind podcast, where we unpack what it really takes to build something that matters. If today's conversation hit home, do me a favor. Share it with someone who's in the trenches too. And if you're building your own brand, platform, or message and want help turning that story into serious authority, head over to theauthorityforge.com to see how we can help. Until next time, keep showing up, keep shipping, and keep chasing the work that sets you on fire. I'm Andrew, and this was the Hustle and Grind podcast.